Welcome to the deep dive. Today, we're really getting into the bedrock concepts of cryptocurrency.
Yeah, it's foundational stuff. Even if you've been around the block, revisiting this can be, well, enlightening.
Exactly. It's easy to get swamped, isn't it? The landscape just keeps shifting.
Constantly.
So for this deep dive, we went back to a really solid resource, the ultimate beginner's guide for how to invest in crypto.
Sounds basic, but there's gold in there.
Right. And our mission today is to pull out those, core nuggets from the early parts. We want to strip away the jargon.
Get right to the heart of it.
Yeah, build a really clear picture of how crypto works, the different asset types, and super important, wallet security.
Critical stuff.
So by the end, you'll have the vocabulary, you'll see how things connect, and hopefully feel more confident navigating this space.
Okay, let's unpack this.
Let's do it.
All right, first things first. You absolutely have to start with the blockchain.
The cornerstone, really. Totally. It's often called this permanent public digital ledger. Basically, every crypto transaction gets logged there.
And the key is permanent. Once confirmed, it's immutable. Can't be changed, can't be deleted.
Which is huge, right? It creates this transparency and trust without needing, like, a central bank or anything.
Exactly. Anyone can look it up with a wallet address, verify it themselves.
Okay, building on that. Crypto wallets.
Ah, yes. The source of much confusion.
Right. People think it's like a digital piggy bank holding your coins.
Yep. Not quite.
The guide is really clear here. It's a tool. It manages the keys. The keys give you access to your crypto, which actually lives on the blockchain.
That's the crucial distinction. It's about control, not storage in the traditional sense, like keys to a P.O. box, not the box itself.
Good analogy. And that brings us to something absolutely critical, the seed phrase.
If you remember one thing.
This might be it. Usually 12, maybe 24 words. This is the master key. It can regenerate all your accounts for that wallet.
All of them.
Lose this phrase.
And you lose access. Period. Forever.
It's like the ultimate self-custody power, but also...
The ultimate responsibility.
Yeah.
Single point of failure if you mess it up.
Okay, then there's the private key. This one's more specific, right?
Yeah.
Unique to each account on a blockchain.
Exactly. It's what actually signs your transactions, proving you own the funds and giving permission to send them. Mostly happens behind the scenes in your wallet software.
Gotcha. And finally, the easy one, the public address or receiving address.
Yeah, that's the one you share, like giving someone your email address or bank account number so they can send you something.
Safe to share, doesn't give away control.
Precisely.
So how do these all fit together?
Oh, what's fascinating is the hierarchy. The seed phrase is the root, right? It mathematically generates all your private keys.
Okay.
Those private keys then authorize actions for your specific public addresses on the blockchain.
Ah, I see.
So it all comes back to that core crypto idea. Control your keys, control your crypto. If someone else holds those keys, well, they control your assets, not you.
That's a huge mental shift for people coming from traditional finance.
Sounds fair.
And sort of extending that idea of automated, locked-in rules, smart contracts.
Right. These are like little programs living on the blockchain.
Self-executing, the source calls them. They just run automatically when certain conditions are met.
Yeah, think crypto swaps without needing a middleman. But the potential is way bigger.
Like what?
Well, DeFi uses them heavily for lending, borrowing, complex trades. But you could automate supply chains, insurance payouts, digital identity, anything based on pre-agreed rules, really.
All without needing a third party to enforce it. Trustless interaction.
That's the promise, yeah. Trust in the code, not an intermediary.
Okay, let's shift gears a bit. Let's talk about the different types of digital assets you might run into. It's not just Bitcoin anymore.
Far from it.
So first, you have coins. Native assets, right? Like Bitcoin, BTC, for the Bitcoin network.
Exactly. Or Ether for the Ethereum network. They're fundamental to their own blockchains.
And their main job is often paying transaction fees on that network, like gas.
That's a primary use, yeah. The fuel for the ecosystem.
Okay, then you have tokens. What's the key difference?
Tokens are built on top of existing blockchains. They don't have their own native network.
Ah, so like many of the tokens we see are built on Ethereum using standards like ERC-20.
Precisely. They leverage the underlying blockchain security and infrastructure.
Why does that distinction matter so much?
Well, if we connect this to the bigger picture, it tells you about the project's architecture. Is it building its own foundational layer like a coin? Or is it creating an application within an existing ecosystem, like a token?
Okay, that helps frame it.
It also impacts things like where the value accrues, the governance, the technical dependencies.
Yeah.
Understanding if it's a coin or a token is step one in analyzing it.
Got it. Then there's the term altcoins. Pretty simple one.
Yeah, basically any cryptocurrency that isn't Bitcoin.
So ETH, SOL, XRP, Cardano, all altcoins. But that's a huge category, right?
Massive. Layer ones, DeFi tokens, metaverse tokens, privacy coins, the list goes on. Altcoin just means alternative to Bitcoin.
Okay. Now for the wild side. Meme tokens.
Ah, yes. Dogecoin, Shiba Inu.
The guide calls them highly speculative, born from internet culture, often with minimal real utility.
That's generally accurate. Their value is driven almost entirely by community hype, social media trends, sort of like digital beanie babies sometimes.
It's a fascinating social phenomenon, though. How much value can be generated from, well, a meme?
It definitely is. Shows the power of narrative and community in this space.
Then at the other end of the spectrum, volatility-wise, you have stablecoins.
Right. These are designed specifically to avoid that crazy crypto volatility.
How do they do that?
They're typically pegged or tied to the value of more stable asset. Most commonly, the US dollar, think USDC, USDT.
Okay.
But you also see ones pegged to gold, like PXG or other currencies.
And the point isn't really long-term investment growth.
Not usually, no. They aim to hold their value. People use them as a safe parking spot for funds during market dips, or for efficient transactions without converting back to fiat.
Like digital dollars you can move easily on the blockchain.
Pretty much. Though it does raise important questions about how they maintain that peg and the risks involved if they fail. Not all stablecoins are built the same.
That's a really crucial point, and it leads us perfectly into managing your crypto, wallet types, and security.
The practical side.
And the source really hammers home this one theme, and we should too. Control your keys, control your crypto, lose your keys, lose your crypto.
Absolutely fundamental. If you take away one thing about security, that's it.
Okay, so let's break down the types. First up, custodial wallets.
These are the ones usually run by third parties, like exchanges, Coinbase, Binance, Kraken.
Right, and the pros are obvious, right? Super beginner-friendly, easy interface, often have password recovery.
Convenience is the big selling point. Feels familiar, like online banking.
QQ. The big con.
The big one. You don't actually control the private keys.
The exchange does, which means you're trusting them completely with your assets.
Exactly. They can freeze your funds, they can limit withdrawals, and...
Well, we saw what happened with FTX.
Precisely. The exchange can collapse, go bankrupt, get hacked, and your funds can be lost or tied up indefinitely. Huge counterparty risk.
So convenience comes at the cost of control and trust in a third party.
Which really raises that important question. What's your priority? Ease of use or true ownership and control?
It's the core trade-off, isn't it? With custodial, you're trusting an institution again, which kind of goes against the whole decentralized idea of crypto.
It does. So that brings us to the alternative.
Non-custodial wallets.
Where you hold the keys.
You, the user. Nobody else can access or block your funds without those keys. True self-sovereignty. Be your own bank.
Okay, but even within non-custodial, there are differences. First, hot wallets.
Right. These are software wallets, usually browser extensions like MetaMask or mobile apps like Trust Wallet. Super convenient because they're online, easy to connect to DeFi apps and stuff.
But being online is also their weakness.
Exposed to malware, phishing attacks if your computer or phone gets compromised.
Exactly. The keys are hot because they're connected to the internet.
And the Fort Knox option, cold wallets.
Or hardware wallets, yeah. These are physical devices, like a USB stick.
And the whole point is storing your keys completely offline.
That's the key. Offline storage makes them basically immune to online hacking attempts. Malware on your computer can't reach the keys on the device.
The source mentions strong security features too, like secure chips, PIN codes, tamper resistance.
Yeah, they're built for security above all else.
Yeah.
They act like a digital vault for your keys. You typically only connect them when you need to sign a transaction.
Maximum security, but maybe slightly less convenient for daily trading.
Generally, yes. More steps involved to make a transaction. It's about finding the right balance for your needs.
So, quick recap on wallets.
Sure. Custodial.easy, but you trust a third party. Non-custodial hot wallet. Convenient, you control keys, but online risks. Non-custodial cold wallet. Maximum security, you control keys. Offline. Less convenient for frequent use.
Understanding those differences is just crucial for making informed choices.
Absolutely.
Yeah.
It dictates who truly controls your assets.
Okay. So that brings us towards the end of this particular deep dive. Hopefully, this has armed you not just with the lingo, but a clearer structural map of how crypto works.
Yeah, the core mechanics, the asset types, and the critical security layer of wallets.
You've got a more robust foundation now, maybe like a better survival kit for navigating this space. And the guide we use today, that ultimate beginner's guide, it obviously goes much deeper. Hints at future topics like research methods, fees, buying strategies, taking profits, taxes.
Lots more to learn.
Yeah.
It's an ongoing journey.
Definitely. So we encourage you to keep digging deeper.
And maybe a final thought to leave you with. This whole control your keys thing, it's more than just security, isn't it?
How do you mean?
Well, it signals a pretty profound shift. It asks you to be your own bank, to take on that responsibility directly.
Right. No safety net from a bank if you lose your keys.
Exactly. But with that responsibility comes real empowerment, true self-sovereignty over your digital assets. So the question for you listening is, what does embracing that responsibility, that empowerment, actually mean as you navigate this whole new financial frontier?
Something to definitely think about.